Welcome to another episode of Regtalks. In the next few minutes, we'll walk through 6 key tax developments from the past week reported by Regfollower. The Dominican Republic's temporary corporate income tax increase, Kenya's Finance Act 2026 and its reduced corporate rate, Luxembourg's Pillar 2 compliance clarifications, Peru's extended local file deadline, the US Section 301 investigation into Germany's pharmaceutical pricing, and Vietnam's guidance on country-by-country reporting through automatic exchange. Let's get into it. Dominican Republic temporarily raises corporate income tax. We begin in the Caribbean. The Dominican Republic has enacted Law 3026, a wide-ranging package of tax reforms. The headline measure is a temporary 3% corporate income tax surcharge. For large taxpayers with annual revenue above 1 billion Dominican pesos, the rate rises from 27% to 30% for the 2026 to 2028 fiscal years, while the standard 27% rate stays unchanged for other companies. The law reaches well beyond the corporate rate. It amends VAT, the IDBIS, the selective consumption tax, individual income tax, and gambling and fuel taxes, expands the simplified tax regimes, updates compliance rules, and introduces a temporary fiscal amnesty running through 31st December 2026. Kenya assents Finance Act 2026 with a reduced corporate rate.
Moving to Africa. Kenya's Finance Act 2026, effective 1st July 2026, takes a compliance-first approach rather than raising headline taxes. It grants a tax amnesty until 31st December 2026, expands selected VAT exemptions, and revises excise duties. On rates, the corporate tax for non-resident companies falls from 37.5% to 30%, with a 15% rate for qualifying mining income. At the same time, transfer pricing rules are strengthened through refined ultimate parent entity definitions aimed at improving country-by-country reporting and curbing profit shifting by multinational groups. Luxembourg clarifies Pillar 2 compliance and registration. Back in Europe, Luxembourg's Administration of Direct Contributions, the ACD, has issued updated FAQ guidance on implementing its Pillar 2 law, clarifying tax assessments, registration, reporting obligations, and transitional rules for in-scope multinational groups. The guidance confirms that all Luxembourg constituent entities, joint ventures, and certain investment entities must register. It sets out filing requirements for the Globe Information Return, the Income Inclusion Rule, the Undertaxed Profits Rule, and the Domestic Top-Up Tax, and provides temporary GIR filing relief alongside detailed transitional deferred tax rules, including the treatment of disclosed deferred taxes. Peru extends the 2025 local file deadline. Across to Latin America, Peru's tax administration, SUNAT, has extended the filing deadline for the 2025 informative sworn statement known as the Reporte Local, the local file, virtual form number 3560, moving it from the usual June deadline to the due dates for the October 2026 tax period. Introduced by Resolution number 000113-2026/SUNAT, the extension applies to taxpayers exceeding 2,300 tax units in accrued income. The deferral also gives SUNAT time to update the form to reflect recent legislative changes to transfer pricing valuation methods. US opens Section 301 investigation into Germany's pharmaceutical pricing. To transatlantic trade. The US Trade Representative initiated a Section 301 investigation on June 18, 2026, into Germany's pharmaceutical pricing policies to determine whether persistent underpayment for innovative medicines is unreasonable or discriminatory and burdens US commerce. The probe follows unsuccessful bilateral discussions and concerns over proposed German legislation that could further reduce pharmaceutical spending. The investigation will include consultations with Germany, with public comments due by August 10, 2026, and a hearing scheduled for September 22, 2026, focused on pricing practices and reimbursement policies. Vietnam clarifies CbC reporting through automatic exchange. Finally, to Southeast Asia.
Vietnam's General Department of Taxation has issued guidance under the country-by-country reporting Multilateral Competent Authority Agreement confirming activated exchange relationships with 37 jurisdictions. Under official letter number 3810/CT-CS, where a Vietnamese taxpayer's ultimate parent entity files a CbC report in a jurisdiction with an activated exchange relationship, the Vietnamese tax authority will receive it automatically, eliminating the need for local filing. The guidance also references proposed amendments to Decree number 132/2020/ND-CP on transfer pricing documentation and CBCR obligations. That wraps up our roundup. This week's themes point in a familiar direction. Pillar 2 is settling into operation in detail, with Luxembourg spelling out registration and transitional mechanics for in-scope groups. Transfer pricing continues to tighten, from Kenya's refined ultimate parent entity definitions to Peru's local file deferral, and Vietnam's move to automatic CbC exchange. And rate policy is diverging, with the Dominican Republic layering on a temporary surcharge even as Kenya cuts its non-resident rate. Add the US Section 301 probe into Germany and the through line is clear. Tax and trade pressure is increasingly cross-border. Staying compliant means keeping up with these operational realities. Thanks for watching Regtalks. See you next time.